Let's bring in Wells Fargo Investment Institute Senior Global Market Strategist Samir Samana now, about 25 minutes into today's trade. Samir, good to see you really playing to type today, this market. Growth leading value, the S&P kind of in this same range you've been in for a few weeks. How would you play it, and what's priced in heading into earnings season?
Sure. I think the range part is probably the key part here. We just don't see a market between now and year end that's going to break out really either higher or lower. Clearly, what's keeping it constrained kind of from breaking out is COVID and some of these issues around the elections. And what will probably keep it from breaking down will be the Fed and policymakers. And so you try and kind of figure out what areas might continue to be in kind of those secular uptrends. And you guys have talked about a lot of them this morning, right? I mean, if you look at technology, that's our most favorable sector. And then if you look at consumer discretionary, especially parts of e-commerce, home improvement, those have done well, communications, right, social media, et cetera, healthcare and the financials. That's kind of our playbook for the remainder of the year and probably even beyond. But again, we don't see a breakout until you probably get past the elections.
Financials would be the outlier there, though, in those sectors that you mentioned in terms of this persistent weakness, Treasury yields remaining very, very compressed. What changes the story there? Because, the good news on the banks is that, they're well capitalized. The bad news is that capital's there to be burned up in credit losses if things don't go right.
Yeah, no, it's a great point. We like the valuations there. Now, the tricky part is they're cheap for a reason. If, as you mentioned, those losses start to tick up and there is, call it a much more severe recession than what we expect right now. But at least our base case for now is that Q2 was the trough. Q3 is a recovery, and then we kind of settle into kind of that steady Eddie growth rate that we saw kind of pre-COVID as we kind of learn to deal with these coronavirus outbursts. So again, it's more of a value play. It's maybe a longer term horizon play than some of the others, but it kind of helps to round out the exposure.
Chinese stocks taking off. You have European numbers starting to look a little bit better. Where's the global allocation wisdom sit right now?
Sure. So we've been unfavorable on both developed market equities and emerging market equities. Now, one of the things that's starting to change around the edges that we're starting to kind of think about is the dollar, right? If the dollar were to break down meaningfully, this regime that it's kind of been in since 2017 to the upside, if it kind of goes back to the weakness that we saw in 2017, clearly the playbook would have to shift, right? It would be much more about emerging markets, developed markets, and large caps over small caps. We're not quite there yet, but that's probably the factor to watch is the dollar. We don't think, much like the markets, it's going to have a meaningful breakdown just because you do have other central bankers also trying to protect their currencies. But if that were to happen, that's the key to start moving internationally.